Okay, dear students, let's start another question on final accounts. The last topic of FR we continued from the previous class, and that's the second question on final accounts. Two more to go, but obviously after two, your FR syllabus will be completed. But practice videos slowly and gradually I'll keep uploading. MIMS company question. It came in December 21, 2021. So obviously take it as a not a very old question, of course. Let's read the requirements. The requirements are very interesting. Within the 20 marks, examiner has asked many things, I would say. Prepare a statement of profit and loss for the year ended December X5, 12 marks. Prepare a statement of changes in equity for MIMS company for the year ended December X5, 5 marks. C. Prepare the following extract from the statement of cash flows for MIMS company. Cash flows from investing activities and financing, 3 marks. Great. At least we should appreciate the examiner for the creativity. That within 20 marks, examiner has asked the profit and loss, statement of changes in equity, as well as something relating to cash flow statement as well. Wow. So let's read the question. The following is an extract from the trial balance of MIM company for the year ended December X5. Revenue, cost of sale, okay. The following information is relevant. Don't forget one thing, that we are here to prepare profit and loss for the year ended December X5. MIMS company noted there an error in the inventory count on December X4 previous year, meaning that closing inventory balance in X4 financial statement was overstated by 0.7 million. No entries have yet been made to correct this error. Now, please, let me first tell you what has actually happened. Basically, December X4 closing inventory is overstated by 0.7 million, means 700 if I ignore 3 zeros. Now try to understand. In 2000 X4, closing inventory was overstated by 700, which means that increasing closing inventory means X4 profitability has increased also. Because increase in closing inventory means profitability will also increase. So we can say that in X4, actually, not only the closing inventory is overstated by 700, of course, in X4, the closing retained earning is also overstated by 700. And number two, X4 closing retained earning is the opening retained earning of X5. Repeat. X4 closing retained earning. Actually, it works as in closing inventory of X4. Closing inventory of X4 is actually the opening inventory for X5. It means opening inventory of X5 is overstated. Increase in opening inventory means your cost of sale is also overstated. Because opening inventory is directly proportional to cost of sale. So basically, what this error has done, this error has actually increased the closing inventory of X4 and the retained earning of X4, and it has also increases the opening retained earning of X5, and it has increases the cost of sale of X5. Now, the correction. Let me just show you the working through a double entry. The correction will be, if we are going to correct this, Obviously, closing and the correction will be in X5. Now listen carefully. Closing inventory of X4 is overstated. If the closing inventory of X4 is overstated, it means opening inventory of X5 is overstated. So we'll simply debit this opening retained earning. And number two correction. Obviously, opening stock is overstated by 700. Increase in opening stock means the cost of sale is also increased. So simply reduce the cost of sale. So let me repeat. Obviously, we are making the correction in X5. The impact of this correction will be opening retained earning will be reduced by 700 and cost of sale will be reduced by 700 because in the current year, your cost of sale is overstated by 700. So if you credit, your cost of sale will be automatically corrected. X4 retained earning is increased by 700. So X4 closing retained earning means X5 opening retained earning. So logically, you can say that X5 opening retained earning will be debited due to the correction of error and cost of sale of X5 will be credited. This is point one. The provision relates to a court case in existence since December X4. Provision at 1st January X5, start of there, is 4,600. MIMS Company settled this case on December X5 for 6 million. The full amount was credited correctly to cash. So they've credited the cash by 6 million, fine, with a corresponding debit entry made in the suspense account. Wow. So the problem is with the suspense account. They have debited, so double entry which company has made, they have debited the suspense account by 6 million and they have credited the cash by 6 million. So we have no issue with the cash credit. The problem is why you have debited the suspense account. Let me show you the correction. Working two. Debit. Already in the trial balance, there's a provision of 4,600. Already in the trial balance, there's a provision of 4,600. Let's credit the suspense account by 6,000. So obviously 12 or 14, the difference 1,400 is your expense. Repeat. Already they have recorded the provision of 4,600, which you can see in the trial balance. But actual on the settlement of this court case, company, they paid 6 million rather than 4.6 million. So 4.6 million provision is debit. Suspense account, they have debited, so we have credited. The difference is the expense and take that into administrative expense. Administrative expense. Administrative expense, which is 1,400. Okay, now. The income tax figure in the trial balance relate to the under over provision. Very simple. If the income tax figure is coming on a debit side of the trial balance, then it is under provision. If it is coming on credit side, then it is over provision. From the previous year. And we know that under provision increases your current year income tax expense. The current year tax is estimated to be tax refund. There will be a 1.2 million refund. Wow. In addition to this, the deferred tax liability on December X5 is estimated to be 8.2 million. Let's come here. Trial balance, trial balance, trial balance. Income tax value, we have 140. This is under provision because of debit side. Deferred tax. Deferred tax is 7,700. Now, just let me make a T account for you. When we discuss IAS 12, so obviously we did discuss how to make the T account for the taxation. We do not have a credit side over provision of the current tax. We have a under provision. So BD comes on debit side if it is under provision. So BD of current tax is 140. Deferred tax is 7,700. They have given us the closing CD of the deferred tax. This is deferred tax. 8,200. Now, interestingly, the main point is that in the current year, there is no income tax liability. In fact, there is an income tax refund. If it is refund, it will come here, which is 1,200. Let's see. Normally, current tax CD balance comes on the debit side, but this 1,200 is not a liability, it is a refundable asset. That is why it is coming on debit side. I'm getting 8,900. So it has to be 8,900 also. So let's see how much will be credited to the statement of profit and loss. Net tax credit to statement of profit and loss, the balancing figure. 8,900 minus 8,200 minus 140. I'm getting 560. If you just recall IAS 12 when we discuss, normally the balancing figure of tax comes on the credit side. Now it is coming on a debit side, so 560 is your net tax credit to the statement of profit and loss, which means that you will not be paying 560. Basically, you will be getting this 560. So normally, if I talk about the normal taxation T account, normally tax charge to the P&L comes on the credit side. But if it is coming on a debit side, so it is credit. This 560 will be added to your profit before tax. It will not be deducted from your profit before tax. So let me just show this here in a working. Tax expense, let me show you through working. We have under provision, and we know that under provision actually increases the current year income tax expense. Under provision from X4 is 140. In the current year, we do not have 1,200 liability, we have refundable. So current year, estimate is 1,200 refundable. Okay. Increase in deferred tax liability. Your closing deferred tax liability is 8,200, opening is 7,700. So there's a rise of 500. So there will be net credit to the P&L is 560. Net tax credit to statement of profit and loss. Now let's discuss 4 point. On 30th September X5, MIMS Company made 1 for 4 right issue. The exercise price was 3.5 per share. The proceeds were correctly accounted for in cash. So cash debit is correct. With a corresponding credit entry made in the suspense account. Wow. Instead of crediting the share capital with the par value and over with an amount which is over and above the par value, they should have credited the share premium. So instead of increasing the share capital and share premium, they have actually created the suspense account. So logically, we will debit the suspense account. With the par value, will increase share capital and remaining is share premium. So the double entry which company has made, they have debited the cash and they have simply credited the suspense account. So obviously we have no issue with the debit. We do have the issue with this credit. They should have credited share premium, share capital rather than suspense account. So let's see. Equity share capital par value is 1. It is 60,000. It means share capital is 60. Par value is 1. So the number of shares are 60,000. Let's go for working for right issue. Number of right issues. Let me calculate this first. Number of right issue. There are 60,000 shares before right, and the right is 1 upon 4. It means 15,000. So par value multiplied by 15, your share capital will increase and the balancing figure will be the share premium. So let me first calculate how much cash they have raised by issuing 15,000 rights. The price of the right is 3.5. So issue proceeds 15,000 into 3.5. So actually company has raised 52,500 by right issue. So share capital with the par value 15,000 into 1. So 52,500 minus 15,000 will give you the share premium, or you can directly calculate the share premium. 15,000 into 2.5. So logically, suspense account will be debited by 52,500 and share capital and share premium will be credited. Okay. Now come here. Done with point number 4 also. 5. MIMS Company acquired an investment property IAS 40 for 20 million cash on January X5 and decided to use the fair value model. A very important point is IAS 40 fair value model. Number 1, whatever the change in the fair value comes, that goes to statement of profit and loss. Second, IAS 40 fair value model, we do not depreciate investment property. Investment properties, they will only be depreciated when you are keeping investment properties at cost model. Under fair value model, which is recommendable, whatever change comes in the fair value, that goes to profit and loss, and we do not depreciate the investment property under fair value model. MIM Company acquired an investment property for 20 million cash on January X5 and decided to use the fair value model to account for the investment properties. As the property is expected to have a 20-year useful life, depreciation was recorded on this basis. So actually you made a mistake. You should not have recorded the depreciation. So we have to reverse that. They have recorded the depreciation of 1 million. So we have to remove that. The fair value of the property December X5 has been assessed 22 million. So logically, fair value is 22. You bought it for 20. So you should have recognized the gain of 2 million rather than depreciation of 1 million. Okay. But no accounting has taken place in relation to this. All depreciation amortization is charged on a pro rata basis to admin expense. There were no other acquisition or disposal of non-current asset. So actually we have to remove the 1 million depreciation, which means that we have to reduce admin expense by 1 million. And in fact, we need to recognize the gain of 2 million. So it means working 5. In working 5, we will deal with investment property. So little bit explanation, I is 40. Fair value model. No depreciation. Therefore, depreciation of 1 million will be removed from admin expense and gain of 2 million. That is 22 minus 20 will be recognized in a statement of profit and loss. So actually we need to recognize the gain of 2 million and we have to remove the depreciation of 1 million. Let's go for 6. MIMS Company incurred a number of expenses in relation to brands during that and capitalized the following costs as intangible assets. MIMS Company incurred a number of expenses in relation to brands during that and has capitalized the following costs as intangible assets. 1.3 million cash was paid on 1st April X5 to promote one of its major brand which deemed to have an indefinite life. Okay, now listen and listen carefully. Basically, according to IAS 38, you cannot capitalize your own brand. So what are they saying? MIM Company incurred a number of expenses in relation to brands during that and has capitalized the following costs. 1.3 million cash was paid in 1st April X5 to promote one of its major brands, which is deemed to have an indefinite life. Actually, you have to expense out this 1.3 million because you cannot capitalize internally generated brands. So 1.3 million will be expense out. 2 million cash was paid on 1st October X5 to acquire a brand from one of its competitor. Okay. If you buy a brand, that will be capitalized. MIM Company expects the brand to have a useful life of 5 years. So this brand will be amortized over 5 years. MIMS Company intend to sell after 5 years. At the point of sale, it's estimated that value of the brand will increase, and so no amortization has been accounted for in the current year. So there are two problems. Number one, internally generated brand you cannot capitalize, so we have to expense out on 1.3 million. Second, the brand which MIMS Company has bought, they should have amortized over its useful life, which is 5 years. And from 1st October till December, there are 3 months. So working 6, I believe. Working 6 relates to brands. Internally generated brands cannot capitalize. Therefore, expense out 1.3 million and increase administrative expense. Increase administrative expense. Obviously, the brand acquired should be amortized over the useful life. brand acquired on 1st October X5 for 2 million should be amortized over 5 years, which is the expected life. And amortization charge to admin expense. So simply we'll take 2 million. I'm ignoring 3 zeros. 1 upon 5, only 3 months from October till December. I'm getting 100. Okay, now come here. MIMS Company paid a dividend of 0.04 per share on all existing shares on December X5. Recording the dividend paid in the administrative expense mistake. Dividend payment will reduce your retained earnings. It will not increase your administrative expense. So working 7. Dividends, total number of shares. Of course, before the right, there are 60,000 shares, plus they have issued the right as well. Obviously, the dividend is paid after the right issue. So total shares. Before right, it is 60,000 plus they have issued right. So the total number of shares are 75,000, which means total dividend. 75,000 into 0.04. So 75,000. I'm getting 3,000. And with this 3,000, the retained earning will be debited and administrative expense will be credited. Logically, the double entry of the correction is debit the retained earning, credit your admin expense. Now let's go for working it. Let's calculate administrative expense, what comes in the, what is going to come in actually P&L. Working 8. Administrative expenses. Let us first take the value from the trial balance. And then we did so many adjustments to the admin expense. Trial balance, it is 10,900. So given in trial balance, is 10,900. Now let's go for adjustments. One by one. Working 1, no, working 2. Administrative expense is debit by 1,400. So that is payment on case settlement. That is working 2, 1,400. Okay. Investment property, we need to remove the depreciation of 1 million. And that was working. What is the working number of investment property? It is working 5. Less investment property depreciation. less investment, property, depreciation, that is working. What is the working number? Working 5. Okay, now internally generated brands, 1.3 million expense out, working 6, and amortization is 100. Expense out, brand working 6 is 1300. Brand amortization. Brand amortization working 6, it is 100. Brand, yes. Then finally, we'll remove the dividend because they have dividend payment they have taken to the admin expense. So less dividend. Working 7. 3000. So let's use a calculator. 10,900 plus 1,400 minus 1,000 plus 1,300 plus 100 plus 3,000. Oh, minus 3,000, not plus. So 10,900 and then 14 and this. I'm getting 9,700. Now let's try to prepare statement of profit and loss, part A, 12 marks. I would say quite a lot number of adjustments. Statement of profit and loss for the year ended December X5. A statement of profit or loss. For the year ended December X5. Let's ignore 3 zeros. There is no adjustment in the revenue, just take it from the trial balance. $24,300. So the revenue is 24,300. So the revenue is 24,300. Now let's go for cost of sale. Cost of sale given in the trial balance is 11,000 something. Let's see. Cost of sale is 11,600, and from this we'll deduct 700. Working 1. So cost of sale. 11,600 minus 700. Working 1, 10,900. So here comes your gross profit. So the gross profit is 13,400. Administrative expense we have calculated. I think working it 9,700. Let's go to the trial balance, see is there any other information. Distribution cost is 7,300. We do have a finance cost 1400 as well. Distribution cost 7300. So distribution cost. So distribution cost is 7300. So 13,400 minus the administrative expense minus the distribution cost gives us loss from operations. Loss from operations. 3,600. Loss from operation is 3,600. Deduct the finance cost. 1,400. Let's see, is there any other income? Trial balance. We have investment income of 500 and we do have a gain on investment property 2,000 or 2 million. Investment property we dealt in working 5. So simply you can do this investment income. Given in the trial balance, it is 500 plus take 2,000 from working 5. Or you can separately show as well. Gain on investment property, it is acceptable. I'm getting 2,500. This will give us a loss before tax. Loss. And the loss before tax is 2,500. Because 3,600 plus 14 will become 5,000 negative, and there's a positive 2,500. So loss before tax is 2,500, and we have taxation, which we have calculated already. What was the working number? Taxation working 3, it is 560. It's net credit. So loss for there. $1,940. So loss for there is 1,940. Now let's go for part B, statement of changes in equity. Actually, in a statement of changes in equity, you have to just deal with the equity section, that is share capital, share premium. If you have revaluation surplus, take the revaluation surplus as well. And then it is up to you, either make the total column or not. B, statement of changes in equity. Statement of changes in equity. For the year ended December X5. Let's take share capital, share premium. If you have revaluation surplus, then there will be one more column for the revaluation surplus. We don't have a revaluation in this question. That is where the third and the last column is retained earning. There's no need for the total column. If you want to make, you can make it. Otherwise, not required. And we are ignoring 3 zeros. Statement of changes in equity always start from the opening balance. Share capital, the opening balance is 60,000. There's no share premium. Retained earning, let's see. Trial balance, trial balance, trial balance. Retained earning is 43,200. Opening retained earning is 43,200. Working one, correction of error, prior period error. Prior period error. Working one. Retained earning was debited by 700. This will give us the restated balance on 1st January X5. Restated balance. 1st January X5. Obviously, it will remain same 60,000. 43,200 minus 700 gives us 42,500. During there, they have issued right issue. Share capital will increase by 15,000 and share premium will also increase. Share issue. Let us see the working reference. Share issue, share issue, share issue. That's working 4. Share issue is working 4, working 4, working 4. So share capital is increased by 15,000 and the premium 37,500. Then let's take loss for the year. It is 1940 and less the dividend paid. Dividend paid, I think it was working 7. Yes, working 7 is the dividend paid. So in a statement of change in equity, only the equity section of the statement of financial position comes. Share capital, share premium. If there was, in this question, there's no revaluation surplus. But if there's a revaluation surplus in the question, then one more column comes for the revaluation surplus, then retained earning. And a statement ends on the closing balance. Balance December X5. 75,000, 37,500, 42,500 minus 1940 minus 3,000 gives us 37,560. Now let's go for the requirement C, and we have to just prepare extracts of a statement of cash flows. I think we did discuss this point that entire cash flow statement is not examinable, but extracts are examinable. Like in this question, examiner is asked investing and financing activities only. So extract from statement of cash flow for the year ended December X5. Extract from the statement of cash flows for the year ended December X5. Cash flows from investing activities. Cash flows. Cash flows from investing activities. So let's see. MIMS Company acquired an investment property 20 million. Okay, what else? Okay, a MIMS company acquired a brand for 2 million and there's investment income 500 in the trial balance. So simply purchase of brand. Purchase of brand is 2 million. Purchase of investment property 20 million. Purchase of investment property 20 million. Investment income in the trial balance, obviously we'll take it as a received. Investment, nothing is mentioned, so it is investment income received is 500. So investing activities total is 21,500. Net cash used in investing activities. Net cash used in investing activities. Now let's go for financing activities. Cash flows from financing activities. I think there are just two activities. One is proceed from issue of right shares, and the second is dividend paid. Proceeds from, you can say, right issue. It was 15,000 multiplied by 3.5. 52,500 and dividend paid. We have calculated dividend paid. I think that is working 7. So 49,500 is your net cash from financing activities. Net cash from financing activities. So I would say it's a really, really good question. And I would request immediately after this video, at least practice this question at least one more time. So thank you very much for watching this lecture. Have a nice life.